kick us off here. Let me just kick us off. We are back on the Cashflow Chronicles with our boy, Hot Steven Furillo. But just wanted to give a quick shout out to my boy George over here for becoming a YouTube member. Much appreciated. All that money goes back into the public investment portfolio. Let me just double check that I'm talking through the right mic. I am talking through that mic and headset. We are good. Steven, how you doing, my man? I'm really excited to have you here.
Excited to be here again.
I like your fake bricks, as always.
I'm trying to be like a Mid and Tevis.
Rich.
Everybody says that my bricks look better, but they're fake. So I don't know.
I mean, Emits are crooked, and I mean, I know he lives around New York. That building must be, 1800s, 1700s. I don't know.
I guess everything is better in a computer-generated world.
Everything's. I was about to go down a path of Blade Runner 2049, but anyway. So December 20th. Hope you guys are doing extremely well. Nvidia pulling back. Market was actually doing okay, up a little bit until about the 2 o'clock range. Then it really pulled back for the last 2 hours of the market. Apple continuing to pull back. SPY back below 470. Google actually held up okay today, which was interesting. Amazon pulling back a little bit. Bitcoin still doing well. And oil flat pretty much from yesterday. Henry Hub gas down about 10 cents. So everything doing rather okay from my perspective. We have Steven here to talk to us about ET. We had some people like ET Phone Home, Drew Barrymore, all that. That's what we're talking about today?
No. Don't even do that. How dare you?
We had people that are really interested in the nuance of the oil and gas sector, and there's so much. Like, I think some people, like my one buddy, he knows I work in oil and gas, and I moved away from home. What was that, 10, 11 years ago, and I've been living in Houston ever since. And so he'll just message me like, "Hey, I saw that this oil company was hiring," and I'm like, "That's an oil distribution company. Like I drill for oil in the Gulf of Mexico. Like it's a slightly different." So there's a lot of nuances, right?
Upstream production, the downstream segment, the energy infrastructure segment, which could be anything from storage to liquefied natural gas to pipelines, interstate, intrastate, so many different segments.
I kind of described it like this. So like for people that aren't really thinking about it, like ET is going to be, let's just talk about it in holistic. The people like Phillips 66 and Valero and Sunoco, those guys are like Hershey's, right? They come up with a conglomerate of products that come from kind of an initial feedstock, which is, in that case, cocoa beans, right? And I'm the guy that kind of finds and gets the cocoa beans in the oil and gas industry, if that makes sense. And then the guys that truck the cocoa beans or like ship the cocoa beans to and from are ET. Like that's what we're going to be talking about today. So I know it's not like for like, but at least it gets us
I have a whole PowerPoint that I made for you.
Oh my God. You're a champion.
Well, you know why? A lot of people don't necessarily look at oil and gas from the depth that your knowledge spans or the way that I look at it. So I want to go over kind of a high level overview about where we are in the oil industry. And it's perfect to go over with you because you're in the oil industry.
Yeah. Or at least I lie that I am, but
well,
Am I connected with you on LinkedIn or not yet?
I think so.
Okay. I thought I was. I know I'm with Amit. Anyway, I'll have to
I think so.
Yeah, I'm pretty sure we are. I'll find you.
Dude, I have so many connections on LinkedIn. I can't keep track.
Yeah. That's my next avenue is to
I need to clean that up. Like it gets crazy.
It does. There's a lot of people that I've since followed that turned into weird. Not weird, it's not the right term. They live on there and they post so much information that it's unvaluable.
So I stopped using it. I'll click on the app like once every 3 weeks now. And just to see if anybody messaged me or anything, but it has become Facebook 2.0. Like it's crazy. Not what I signed up to LinkedIn for. But Anyway, that's not what we're here to talk about.
We aren't connected. All right, I just added you.
Okay, I'll check it a little bit. All right,
Cool.
let me share this. All right. So is that a good size?
That's a good size for me, man.
All right. All right.
It's not about the size, it's about the message for me, you know?
Okay. All right. Well, hopefully we get both done for you. Well, global energy is something that is embedded in every society. And if something happened to energy, anarchy would happen. Like, really think about if you went to turn on your lights and they didn't go on, if you had no electricity for your refrigerator, if it's 100-degree day and you didn't have AC, if there wasn't enough plastic to create a computer or different items that you may be using, all that are derivatives of energy. And as this first chart shows, gas, oil, and coal utilization has only gone up as the human population has grown. And we are projected to grow to almost 10 billion people by 2050. I actually think it's 2053 or 2054 that we are going to have more than 10 billion people on the planet. That's an increase of roughly 2 billion people. That's the size of India. 1 + 1 = 2. And if you add 2 billion people, you are going to need more energy from all forms, renewable and oil, gas, and coal. Maybe not coal, maybe coal dissipates a bit, but oil and gas isn't going anywhere. So the everyday products that are made from oil, like a lot of people don't think about this, but plastics are a derivative of oil. Hydrocarbons are the main component of plastics. Everything plastic comes from oil and gas. And when you think about that, that's pacemakers. That's the IV tubes in every doctor's office or hospital, keyboards, cell phones, computers. This actually has an interesting fact that plastics make up 50% of the volume of new cars and only 10% of the weight. I mean, it's in absolutely everything. So I think a lot of people just think about oil and gas as gasoline that goes into your car. Like, I really do believe that that is what most people think of oil and gas as, and it couldn't be the furthest thing from it. Like, it is so much more in depth than that, and it touches our lives from the clothes that we wear to the plastics that we utilize and so many other things, because oil and gas is one of the most abundant sources of hydrocarbons, one of the cheapest feedstocks in manufacturing. You have fertilizers that are completely a derivative of it. Phosphorus, I believe natural gas is one of the main components of phosphorus, which is, I forget what percentage of fertilizer it covers, but it's a huge percent.
Huge point. Yep.
Huge percent.
Which is part of the reason why a lot of people were concerned, going back to, you know, why the oil price was disrupted last year. Ukraine, Russia, those guys have a lot of the phosphorus that comes out and we actually utilize for fertilizers and stuff like that. And that was part of the reasons why people were concerned about global inflation costs. Yeah, and food supply. Yep.
So these are not my numbers, and I can bring up I'm going to plug it. BP is one of my favorite companies for research. They put out a global and world energy outlook and statistical review every year. And it is unbelievable, the information in there. Really top-notch information. So it has all the metrics. And I'm looking forward to the updated version so I can see the 2023 numbers. Oil production versus consumption on an annualized basis for the past decade, excluding this year, because we don't have the final numbers for this year yet, has operated in a deficit. We utilize more oil than is produced every year. These are not my numbers. These are from the Global Energy Statistical Review. Natural gas production and consumption, the spread is a little bit of a surplus, but we basically use everything that we produce. So when you think about that, pretty interesting. Now, countries that produced more than 4,000 barrels per day of oil in 2022, United States was the largest, followed by Saudi Arabia and Russia. Only three that are over 10,000 barrels per day. Canada's number 4.
Now, is this a quick question for you? Is this specifically oil liquids or is this oil equivalent?
Oil equivalents, I believe. We could go to the.
Because I was going to say, I was surprised to see the 17 million there. I was like, oh, I don't know
It's oil equivalents, I believe.
Got it.
Yeah. Let's see. So, billion cubic meters of natural gas produced. Same thing. United States, number 1, followed by Russia. The United States is the largest producer of oil and gas in the world.
Which, when people look at the spread, which I'm sure you'll get to because it's important part of ET, that's why it's so cheap. Natural gas is so cheap. After 2008 timeframe, natural gas prices have plummeted and have hovered around the $2 to $3 a barrel, or sorry, $2 to $3 per Henry Hub, million scuff, right? And so 1,000 scuff, not million scuff. I talk about million scuff all the time at work, so that's my fault.
Well,
so yeah, $2 to $3.
See, you're not faking it. You're in the industry. You're not faking it.
Well, I could have just said that, you know.
Who the hell would have thought of that?
Who would have thought of that?
Who would have thought of that? Anyway, so this is from the EIA. Once again, none of these are my numbers. And I always say that in my Seeking Alpha articles for the simple fact that I am a very data-driven person. And I go by what our government is telling us because this is an independent agency, the EIA.
And these guys also report on renewables, by the way. So it's not like they're biased towards fossil fuels.
And I want to be very clear. I am pro renewables. And I say that all the time. I do believe that this is a sum of everything that we are going to need to meet our future energy demand. It's going to be, my opinion, renewables, oil and gas. And I think coal will decline steadily. But we're going to need more of everything. Now, when you look at the EIA's predictions out to 2050, and this is their report from this year. This is not from like 4 years ago. This is from this year. You have in their reference case that petroleum and other liquids increases a little bit, doesn't really dip, and you have petroleum exports increasing considerably over the next 3 decades. And we're going to get to that. Natural gas, same thing. In the reference case, it goes up and then it dips off a little bit and then comes back up. In the high case, it increases on natural gas consumption. But production is the big thing. Production just goes up. And the reason it just goes up is because of the amount of liquefied natural gas exports. Because as we've seen, anybody who follows oil and gas, there's been huge demand from Europe for natural gas from us. And the best way to ship natural gas, the only way to ship natural gas is through liquefied natural gas because it condenses everything so much. It's not cost effective to ship it any other way. That's why you have all these huge barges that do this.
So when you think about it, I just give people some color on that. When you say it's you shrink it and it's the most cost effective way. Basically what they do is they super pressurize, they super cool all this natural gas. And because of the temperature, it actually is able to shrink to 1/600th of its size. So once you actually bring it back to standard conditions, you're able to expand that volume by 600x, right? So that's why it's so important, because otherwise you'd be having to build pipelines across the Atlantic and Pacific, and then there's also, you have to think, movements on the land, right? The continents are consistently moving away from each other also, so you're gonna have to take that in consideration. So it's much easier to set up these plants localized and then pick from point A to point B with these LNG tankers. And there's LNG tankers that are now being put up all across the Gulf Coast. There's some that are being set up on the Eastern Coast. There's one that I helped work with in Trinidad and Tobago. So lots of fun. There's some on the West Coast of Angola. They're starting some up in Mozambique. Qatar, which is probably something we might talk about maybe a little bit later, is a huge exporter to Europe as well. They provide about 25% of Qatar's liquefied natural gas goes to Europe, and obviously what's going on at the Red Sea impacts that a little bit. But anyway, back to you, Stephen. Just wanted to add some color to that.
So for the U.S., so domestically, energy consumption is expected to increase over the next 3 decades. And I ripped this from Trading Economics this morning, or not this morning. Oh my God, this evening, probably like 2 hours ago. We are at our highest point ever for production on the upstream, with over 13.2 million BPD. It is just, we produce more oil every year, it looks like. It's crazy.
So this is back above pre-pandemic.
Oh,
we
yeah.
got to about 12 and a half pre-pandemic, and things are favorable. And I think it's pretty interesting. Like, people might think, oh, well, there are so many bankruptcies that happened in 2020. And it's like, yeah, I get it. But at the same time, it's like, a lot of that is specifically after like 2014, 2015, a lot of these oil and gas companies, as well as ET and many others, they started focusing on capital efficiency a lot more. And so you have these big players that were being more capital focused and efficient in that respect, and took up and bought these guys for pennies on the dollar. So now they have way more land and their cost basis is way lower. And basically anytime the price becomes favorable, they can just rip open wells and
look, as technology improves, these large upstream producers are able to produce more from their wells. So look, this is, I don't get political in anything that I say. And there is one political party that is looked at as pro oil and gas, and another political party that is looked at as anti oil and gas. But as we can see, we are at a highest point of the past year. And from everything that I have seen, we are producing more oil than we ever have. So take it for what it is. So these are all the oil basins and shale plays in the lower 48 states. So I really
don't care about the Gulf of Mexico, my guy?
The Gulf of Mexico is right here. What are you talking about?
I don't see any of those plays that I work on in there.
Okay, I said in the lower 48 states.
Okay.
Land-based, okay? Of course, there is huge drilling out in the Gulf, but just land-based, because we don't have too many pipelines that go out to the Gulf, but we'll get there. So the Permian, and I would argue that the Eagle Ford is some of the best land there is, but the Permian is the creme de la creme in the U.S. right now with land for oil production.
Why do you say the Eagle Ford is the best?
I didn't say it's the best. I said it is very, very good. Like, I think it's really good. The Eagle
for
Ford.
ET or just in general?
No, just in general. For oil production and gas production, the Eagle Ford is some of the best land you can get. And the Permian is regarded as the creme de la creme. Permian is regarded as the best. That's where everybody wants to land. I actually think that Eagle Ford is, people are going to be surprised what comes out of there from some of the stuff that I've looked at. But you think
it's underdeveloped, and why? Because it's too aerially extensive, or?
I just think people are going to be surprised over the next couple of years.
I feel like that's interesting, because I feel like, sorry for everybody, because I know you're on a really good, but it's like, from a technical standpoint, it's like, people have been developing the Permian for quite some time, and it's like just up until obviously the 2008 when people started turning the drill bit sideways and also started fracking. Did it really? What's that?
All the laterals.
Yeah, all the laterals, and then the extended laterals and everything. But it's like, I feel like the Eagle Ford has kind of been on a quicker rush since like the mid 2000s, versus the Permian, I think, has been on a rush since like the late 2000s. So I'm kind of curious to see why you think everyone rushed to the Permian first. Anyway, maybe it's something we could talk about offline, because that actually,
to high level, I think that the Permian is becoming absolutely commoditized from the heavy hitters, and it's harder and harder. And I think that you're going to see what I would consider smaller mid-cap upstream production companies flock toward the Eagle Ford, for the simple fact that it's pretty hard to go against Oxy, Exxon, and Chevron. I mean, they pretty much control the Permian at the moment.
Yeah.
And I don't see that changing.
Interesting.
So I do
So you
think,
think, so you think from a future you're saying from a future acquisition standpoint, you think there's a lot of cherries to be picked in the Eagle Ford?
I think from land rights and just what the proved reserves are, and as lateral drilling gets better, I think the Eagle Ford is going to make a lot of sense. And
Okay.
strategically, think about it. If you're at the back end, which is a
Mostly
great
has.
great
Yeah.
play, think about how hard it is to get it all the way down here. Like everything happens around the Gulf Coast, and we're
Yeah.
going to get there in a sec. You go to the Marcellus Shale, same thing. Eagle Ford is right on the Gulf Coast. So you think about, it's not just about crude. It's about natural gas also and exporting. That's the big reason why.
So do you think with next decade it's going to be a huge bum
I
rush once
think
that
with
shows
next
up?
decade, I think that if Driftwood comes online and then as Cheniere adds more capacity, Enbridge has their Engle, I forget the name of it, but they have a huge export. There's a lot of exporting facilities down there. So Permian Basin is just a huge basin of oil, and it's regarded as the top basin in the U.S. for drilling.
It makes about 5-6 million barrels of oil a day. And a lot of gas comes with that, but there's not a lot of export opportunities for the gas. It's starting to ramp up better and better, but yeah, that's one of the largest. Actually, it's the largest in the U.S. And yeah, the Prudhoe Bay is way below that now. I'm trying to think who's probably second. It might be the Eagle Ford.
So
After?
when we look at this, the most exporting for oil and gas happens from the Gulf Coast. The most export facilities sit along the Gulf Coast. There's one or two that I can think of. I should have put the slide in here and I didn't. I can get it. On the East Coast, I think there's one or two on the West Coast. Most are in the Gulf Coast. So
Yep.
now when we look at, oh, I'm sorry. I have one more slide before we get to that. I should have changed these around. Permian production forecasts. From oil to natural gas liquids to natural gas, everything is just expected to go up through 2030. These are short-term forecasts. Everything's expected to go up. So you look at Energy Transfer's footprint, and you think about where those basins are. Take away from the back end, tremendous amount of pipeline capacity and storage and fracking and everything else that fractionation, which they do in the Marcellus Shale area, which connects everything to the midstream and mid-continent interstate, interstream, and down to the Gulf Coast with all their terminals, storage, and exporting, and pipelines off to barges in the Gulf Coast. This is the largest footprint of pipelines from any company I've looked at. I think they're at 126,000 miles of pipeline now. Pretty sure that's the number. And then their crude and refined products segment. Why is this still showing up?
Oh,
Can
sorry,
you
that's my fault.
Thank you. So we can see that on refined products is after oil gets treated to be diesel for airplanes or anything like that. So they have a huge refined product segment that connects everything to the Gulf Coast, from the East Coast to the Gulf Coast. They have a huge crude oil segment that moves everything from the Bakken, Permian, Eagle Ford, and some of the Marcellus down to the Gulf Coast. In natural gas, they have a huge amount of pipeline capacity throughout Texas, Middle America. It is simply massive. Now, exporting, which I believe is the big opportunity going forward over the next 5 to 10 years, because of the global energy demand increasing and Europe and Japan and other countries needing, not wanting, but they need our liquefied natural gas. And we produce so much of it that we are able to export at a huge profit for these companies. Energy Transfer is the only company that I know of that has export facilities on the East and Gulf Coast. That is huge. Their capacity is unmatched at the moment. So when you add this in with pipelines, this is where you want to be, or where I want to be.
So I have a question, because I think I know the answer to this, but do these guys really have a trading organization at all, or are they strictly
They
just...
do.
Okay.
They do. So they have acquired 4 companies since the end of 2021, and the Energy Transfer is going through acquisitions. Some people dislike that. A lot of people still dislike Kelsey Warren. I think the guy is a genius. I don't use that word lightly. I think he has built one of the most complicated companies that is needed. I mean, oil and gas transportation is a hard industry. There, and the other thing is, there's a huge moat around all these companies, not just Energy Transfer. You think about pipelines, you want to talk about moats. Put aside financials for a second, where a gross profit margin of 60% for a moat. I can raise money and I can go hire engineers and I can start a SaaS company and I can try to compete. Whether I will be successful is a different story, but there is a market to raise money if you have an idea for SaaS, hire great engineers and try to compete. Anybody can do that. If you're going to be successful, is a different story. Try to raise money and build a pipeline company. It's not happening.
Extremely regulatory intensive. Yeah.
First, you have the red tape from the government. Doesn't matter who's in office. You have tremendous red tape from the government. You need permits. You need Army Corps of Engineers to come out. You need the environmental studies. You need to get past the lawsuits. You need to acquire or lease the land. You need to build. You need to deal with zoning laws in multiple jurisdictions, sometimes hundreds, depending on how long. Think about if you're building a pipeline that goes 300, 400, 500 miles. Think about how many jurisdictions you need to get permitting and zoning for.
How many properties?
Yeah. Then how much land you have to acquire. Then actually connecting your pipelines to other assets so you can actually be a viable candidate. You can't just put up a pipeline. You need to connect to things. And then getting all the contracts. I mean, this is an incredibly complicated business. You can't just get in the arena and compete. And there's a reason new competitors don't come into this industry. And I think that we're just going to see more consolidation, and the players that are there are going to be the players. I don't think we're going to see new companies the same way we haven't seen new companies come in. We've only seen the better companies, or I should say the larger companies, grow. Because look, ONEOK and Magellan Midstream, 2 great companies, but they merged out of necessity pretty much, because it's getting harder and harder for these companies. There is strength in numbers, strength in size. And I don't think we're done. I think you're going to see more consolidation in the industry.
I mean, how many more can you have? Because I mean, it's getting more and more consolidated.
I have a theory that Energy Transfer is going to. I shouldn't say it, but I'll say it. I think you're going to see a major deal. Either I think Berkshire could come in and
Berkshire's pretty big
and acquire Kinder Morgan.
That would actually be really smart for them.
And here's why: they purchased 7,700 miles of natural gas pipeline from Dominion Energy, which was predominantly a utility company that had natural gas assets, and the other
East Coast,
export facility on the East Coast for, I think the deal was $9.6 billion. Now, Berkshire has the political capital, they have the monetary capital, and they have the influence and the expertise through Berkshire Energy to build pipelines. They acquired pipelines for a reason. I think that Kinder Morgan fits into their asset base, and that is an interesting play for them. Or I think Kinder Morgan and Energy Transfer end up merging. I just think that you put their assets together.
You think they would let that happen, though? I mean, Kinder's huge.
Who knows? You still got Enbridge. You still got Enterprise Products Partners. There's a lot of other assets out there. So I don't know if it would fly or not. It would be interesting. You think about ownership, Kelsey Warren, who's long-term people dislike, the guy owns so much of the company. Insiders own about 11% of the company. Kelsey Warren owns billions of dollars worth of Energy Transfer. And since 2019, he's purchased $621 million worth of units. Hey, it's crazy how much he owns. Insiders own 11%.
Purchases have been awarded based off of his ability to execute.
Yeah, it's crazy. So Energy Transfer just acquired Crestwood, and they are earning fees at every junction of the energy transportation segment, everywhere. And pre-Crestwood, they were transporting 31.4 million BTUs of natural gas. I mean, it's absolutely crazy. Transporting 5.3 million barrels per day of crude. It's crazy how big they are. So I went and I looked at MPLX, Kinder Morgan, Enterprise Pride Partners, Plains All American, and Energy Transfer. I am invested in Energy Transfer, Enterprise Pride Partners, and Kinder Morgan. I am not a shareholder of Plains All American or MPLX, but I would certainly like to start a position in MPLX.
I didn't realize that Kinder was this small. I thought that they were much bigger.
Well, this is by revenue, adjusted EBITDA, and distributable cash flow over the trailing 12.
I think the thing that sticks out for me most on that graphic is the DCF for Kinder Morgan compared to the amount of revenue.
If you look at it like that, it is very interesting. Yes, very interesting. So on an enterprise value to adjusted EBITDA, and these are based on today's market caps. I redid these numbers tonight. So Energy Transfer is trading at the lowest valuation at 7.72x. Market cap ratio to adjusted EBITDA. I don't like adjusted numbers, but this is what MLPs use for some reason. So I'm using adjusted EBITDA. They trade at 3.19x their adjusted EBITDA, which is the lowest in the segment. Market cap to distributable cash flow. Energy Transfer trades at 5.47x, lowest in the industry or in this peer group. So
so going back to the price to EBITDA, why do you think that why are you curious why they use that?
Adjusted? I'm not sure.
Just adjusted? You're curious why they use adjusted versus regular, or?
I like using regular. I know that pipeline companies use adjusted because there's some type of something with the taxes or something that they do where they use the adjusted number instead whenever they're doing their debt ratios.
Okay, I never understood that, but
yeah, I haven't looked into it.
I normally just like you said, I use EBITDA, but I understand why most companies use EBITDA just to kind of give like an underlying, like this is the profitability of the business, and then you can load on the debt or anything like that. And I think sometimes people might say, what about the price to earnings? It's like, well, one, these are master limited partnerships most of the time, except for KMI, I think. But the reason why it's kind of peculiar to use price to earnings is also because they can depreciate and amortize a lot of this because they're all very capital intensive businesses. So you might not get a true representation as to what the true value of it is, because that net income that net income value is going to be impacted by non-cash items that are really just there to help with the amount of taxes that the company has to pay. But anyway, back to you.
One sec. So when I look at distributable cash flow, this is one of the most important numbers to me because this is your asset of capital, your pool of capital that you're paying your distributions, which is the equivalent of dividends, and you are funding your organic growth from your retained DCF. I want to pay the lowest number possible for this pool of capital that I can. Energy Transfer is trading at the lowest possible number for this. I mean, it's really crazy that Energy Transfer is that hated or that undervalued, however you look at it, based on all these metrics. So
Do
you
you
look
think
at
KMI is trading at a premium because it's a C corp
could be
rather than
because it's a C corp. Could be because it's only natural gas, not tied to oil. I mean, they're predominantly only a natural gas company when it comes to transportation, storage, and all that stuff. They don't have much exposure to refined products or oil. They may get a premium based on that because there's less. I got to choose my words very carefully, because I don't want to be political in any way whatsoever. There is less chatter and talk about natural gas than oil.
being that I'll say natural gas is more of a transition fuel and will be around potentially longer into the future than, say, crude oil. Potentially.
Yes, I would agree.
Potentially.
So net debt to adjusted EBITDA, Energy Transfer, everybody has flawed them for debt. Okay. They've always flawed them. This is pretty good numbers right now. All these are pretty good numbers. I mean,
that's not bad. Like 3.5 is not bad.
EBITDA is not really a leveraged company. The rule of thumb with these companies is to be around the 4 to
5.5. Oh, okay. You're saying 4.5.
Okay. So that's what I've seen where their target ranges they want to be from the earnings calls I've read.
It starts getting pretty hot when you get to the 5.5.
Yeah. So they all try to be in that 4.5 range or under. And Energy Transfer has consistently come down. I'm going to show it on something else. They've consistently come down. Distribution yield. So you're getting that great of a valuation, and Energy Transfer has a distribution yield of 9.11%. I mean, that's crazy.
It is. One of the things I want to highlight with that last piece, though, with respect to the yield, so I think everybody and their mother is going to see the 9% yield and they say, well, even if this thing stays flat, I can run to this and make 9% per annum. Please make sure that if you, what's that?
Schedule. So I should say that these companies, excluding Kinder Morgan, issue a K1 package.
Exactly.
If you are interested in this area, I seriously encourage everybody to talk to a tax professional, preferably a CPA, on the consequences of holding these, what type of account they should be held in, and all that good stuff. I'm not a tax professional, so I'm not going to offer an opinion on it.
Because even if you make over $1,000, I forget, there's like some
it's UBTI.
Exactly. You end up hitting a threshold where you still end up having to pay something, even if it's in a tax advantaged account, right? So just be sure that you're always, and you don't have to worry about that with a Kinder Morgan, right? Specifically,
no, it's a C corp. So most likely your 1099 from your brokerage company will take care of all that.
Yeah. So, and what that difference is really, it's like, so Kinder Morgan will take taxes at the corporate level. So they'll pay the 15-20% tax or whatever, based off of the dividends that they're paying out, or just the net income that the company produces. Versus, let's just say, I'm not a tax guy, right? So I'm gonna fumble this pretty bad. But versus a master limited partnership, everyone's taxed at the partnership level. So you don't technically own shares; you own a percentage of the partnership. Yeah, you own units of the partnership. And so with that, you are supposed to be taxed at the unit level. And so that has been very much dependent upon, well, how much does this person make and everything the like. So it's very much more complicated than to say, oh, well, let me just add my 15% if I'm below, the 15 to 20% tax threshold for dividends, or your 20% if you're above that. It's more like, well, what income tax bracket are these people in? So for me to own a master limited partnership outside of my Roth is probably not very smart unless it is a massive dividend yield like we have here, because I'm earning close to, let's just say, north of 28% tax bracket, right? So it's not going to be bueno for me, because I'm going to be taxed at a massive rate comparatively to, say, somebody that's putting it in a Roth and somebody that's maybe in the 0 to 15% tax bracket.
So as I was saying before about the net debt to adjusted EBITDA level, a lot of people were bashing Energy Transfer because of the high debt. They did end up reducing the distribution in 2020 and going on financial discipline. They have done an exceptional job. So when you think about what they've done, they have gone from having 52.33 billion in total debt in 2020 to having 48.9 billion in the current Q3 of 2023. That may not seem like a huge deal, 3.6 billion or so. May not seem like a huge reduction on the total debt level. But when you think about the 4 companies that Energy Transfer has acquired, they have decreased their total debt by 3.5 billion or so. But when you look at what they've done on their income statement, and 2020 is an anomaly. So go back to 2019, 53.3 billion in revenue. After the other revenue, you had 54.2 billion. In the TTM, they're at 78.55 billion. I mean, you're increasing by $24 billion in revenue and declining your total debt and paying down your debt obligations. I mean, it is absolutely crazy to think that this company is still hated. You look at the cash that's being produced from operations. I mean, 2021 was an anomaly year, but cash from operations is growing. CapEx is going down. That's the big thing. You look at the amount of assets that they've acquired, the amount of assets that they have put into service, they don't have to spend nearly as much in CapEx anymore. So those years when they were spending 7 billion and then 6 billion, 5 billion, now they're spending less than $3.5 billion while their cash from operations is going up. So you think about it, less debt, really attractive net debt to adjusted EBITDA ratio. You have more free cash flow, more distributable cash flow coming out, and you're trading at peer group lows. I mean, this company should, in my opinion, be valued more like $18 or $20 a share. Shares are at $13.72. And then when you look at what they've done with the dividend or distribution in their respective, they cut it by half. You've got in 6 increases in the past 2 years. And the distribution is now larger than it was pre-cut. So not only did the distribution get back to where it was, you take off $3.5 billion worth of debt and you increase the numbers that they're producing and you make the company more efficient. I mean, this is one of the companies that I think is truly undervalued in the space.
I am curious though. So you were talking specifically about the gross profit. Well, you didn't really highlight it much, but it was like an $11 billion gross profit back in 2019 for $53 billion of revenue and only just above 13 billion for 77 billion in revenue. So that means like the gross profit margin went from like 20 and a half down to
Margins
like
are not
17.
as good as the other companies, but I look at sheer adjusted EBITDA and DCF.
Yeah.
If I'm looking for the best bang for the buck on margins, it's going to be a different company. But if I'm looking at buying units of a company or being an owner in a company, I want to buy a pool of adjusted EBITDA or a pool of DCF at the cheapest valuation that I can.
Now, I have a silly question. I mean,
no such thing.
So when you look at, I mean, these guys are heavily concentrated around the Gulf Coast. You showed that and made that very clear. When there's already a lot of competition going on from the LNG perspective, but like you mentioned earlier, Driftwood, with the recent CEO changes there, could be kind of getting pushed forward. Next decade, they actually have shovels in the ground. So do you think that over, let's just say, the next 20 years, that the toll roads that are these pipelines concentrated around the Gulf Coast specifically will have massive increases in prices. And so right now they're more so just focused on just acquiring and letting inflation do its thing to just get as much debt and as much as they can on the balance sheet. And then the next 10, 20 years, they can just expand the amount of margin they get because they've already acquired everything. And everyone's going to be fighting for competition, which they already own the majority of.
Yeah, I mean, there's two types of contracts, take or pay or fee based. So take or pay, and I haven't looked at this in a while. If I remember correctly, correct me if I'm wrong. Take or pay is if Matt owns a pipeline company, I am going to contract him for X amount of space, and I'm going to pay him regardless if I use it or not. So if I use it to the capacity, great. If I use 50% of the capacity of that contract, I'm still paying him for the 100% because I'm basically committing to using that capacity. Whether I use it or not is negligible. It doesn't matter. Fee based, you are contracting space and you're paying based on the volumes that you're transporting through the pipeline system. So I think that over time, as you see more consolidation, I think that you will see prices increase. And I would think, and I do not know this for sure, it's probably somewhere in the 10K that I missed. I would think that if companies are signing multi-year contracts, it would be the same thing as what I've seen with SaaS companies, that there's probably price escalators on an annual basis, 1 or 2%, something like that. Same way that a triple net lease rent company REIT would increase rent on their tenants. I don't know. It may not be like that. I'd have to double check, but I would not be surprised if there's some type of price escalator in there. But other than that, I think that over time, renting space will get more expensive. And look, where else are you going to go? You know, when there's only a couple of companies that do this, there is not many options. And quite honestly, this is the most efficient and safe way to transport. Transporting by rail or truck is not nearly as safe or efficient as pipeline.
Okay. Yeah, no, I hear you there. I did have a question.
Yeah, I
Well,
see it. I
we
don't
did
know
have a
off the top
question
of
in
my
the
head.
chat.
I'd have to pull up their 10K and look.
Yeah, I'll pull it up real quick and see if I can find anything in here. But I'm curious, like, we talked a little bit about, I know you're a big dividend guy, your dividend streams, right? And for anybody that doesn't follow Steve on Seeking Alpha, please do that. There's the link to his article in the description that goes into more depth, and I'm sure it has a lot to do with what we talked about here today. But also, make sure you follow him on Twitter because he's always releasing content, not just on ET, but a multitude of different companies that he follows.
Let me plug the poll. So I am in a debate right now. Somebody is trying to convince me that Harry Potter is a better movie than Braveheart, which I think is absolutely crazy. And I put a poll out on Twitter to see what everybody thinks. So please vote.
Please vote. I'm curious. I'm not on mute, am I? Okay.
No.
Sorry, I'm looking in the other screen. I know you're big on some of these other guys. You alluded to some other pipeline. Sorry, I got the hiccups. Some other pipeline companies in which you own. Do you own a lot of LNG companies as well, or is it kind of like meh?
So what do you mean by LNG? Do you mean transportation or production?
I mean specifically like Cheniere or Next Decade or anything of the like.
No. I have shares of Trillion as kind of a cheap lotto ticket. Exxon Mobil, BP.
No Shell or Total for LNG?
No Shell, no Total. Considering a position in Chevron if it continues to come down.
Let me ask, why Exxon and BP for LNG exposure?
Exxon I invested in after the decline from COVID. I think my average per share is probably 48 or so.
Okay.
That area. I just happen to think Exxon is the one. There is a lot of them. I just happen to like Exxon. And I try to buy companies that I use, and I use Exxon. It's where I fill up, kind of obligated. Got to support where I get my gas from. There's no Chevron stations near me. Other than that, Kinder Morgan and Enbridge Enterprise Private Partners, I'm sharing unit holders of 10K. I think that's it. I got killed on Chesapeake. Unfortunate situation there. But other than that, no, that's it.
Okay. I just, part of the reason why I own Shell is the, obviously I've company shares in UDOC, but part of the reason why I own Shell is because of their LNG portfolio. And I've looked at what Total is doing. So Total is already having a lot of offtake scheduled for next decade, which is the Rio Grande LNG project, which is kind of talking about with the Eagleford, what you were kind of talking about earlier with that. And then you also have Tellurian Driftwood, where they have offtake potential there. But I just looked at their LNG offtake schedule for Total, and it's pretty wild where they're at today and where they plan to get to. So it just makes me think, like, is that a good play as you kind of transition into the second half of the decade? And anyway.
Yeah, it could be. I mean, I don't know. I think there's a lot of good buys out there still. So I may add some companies. We'll see. I feel like you were going to ask me a question about dividends, and we kind of got sidetracked.
I wasn't necessarily thinking. I know you're a big dividend guy. I'm just trying to think. I was just more curious about what other energy exposure you kind of have. Do you do any of the refineries at all, or not really?
No.
Okay.
I should have invested in Valero, but I didn't. I mean, look, if one of them, or Phillips 66 comes down, I would probably invest because we're at max refining capacity. I think that they're good values and we're going to need them for decades to come. So I would definitely look to add one of them at some point. Not opposed to it.
Yeah, I've owned Phillips 66 twice.
Do you consider utilities energy companies? That's a no.
Not really.
Okay.
I mean, I own Nextera, if that's what you're asking. Like, do I own any
No,
utility?
I was just wondering, only because I own a couple. I own some closed-end funds also.
Okay.
And then I own AMLP also for an ETF for the pipelines I don't have.
Okay. Yeah, I'm looking for the schedule in the 10Q, and I don't really see it. I see that they're very transparent about some of the recent bonds and everything that they've issued over the course of 2022 and 2023, and what their due dates are. But it seems like they're getting pretty favorable terms for some of the stuff here in 2023 timeframe. Some of it was at like 4.5 to 4.75. And then some of the more recent stuff was in like the low sixes. So I don't think that they're getting gouged when it comes to, even if they do have to refinance. I think they have plenty of cash flow from operations and wiggle room to be able to pay down some of that stuff. I don't think that they're in a big crunch. And like you stated earlier, their net debt to EBITDA is only 3.5. So it's like they have plenty of room to be able to reissue it at a higher rate if they need to.
I mean, think about it like this. This is a company that's generating $12.23 billion in EBITDA annually. It's a lot of money. A lot of room to pay down debt. So I'm not worried about it.
So I do have some thoughts. I mean, where do you see this, knowing that how we're going to be transitioning into the second half of next year? Rate cuts are kind of on the table. Do you think that these are good opportunities here as rate cuts are kind of coming to a likelihood? And then with that, do you think that the fact that these are higher yield will drive people out of, say, buying something like some of these bonds and push them into this, which would if you have a lot of demand for a company like this, it'll eventually push the price down, and maybe the yield will go into the 7.5%, 8% range. And obviously with that, you'll see a 10, 15, 20% uplift in the price.
So I've been saying this since before it was popular. I've been writing about it in a lot of my articles. For the high yield stuff and some of the funds, I've been doing a couple of paragraphs about the macroeconomic landscape and how I feel it is going to play out for next year. So far, I've been pretty correct. My opinion at the moment is unchanged from where it has been. Matt, you still there?
I'm still here.
Okay.
I think my connection's being fishy, so I'm
Okay.
just taking off my camera.
So, in a nutshell, and I'll try to keep this brief, you have $6.1 trillion sitting in money market accounts per the St. Louis Fed as of December 8th, I believe. Went up since November 15th from 5.7 trillion. Anybody who is serious about generating yield for the long term and locking in these abnormal rates from what we've seen in the past decade or so would have done a long-term CD or a long-term T-bill at 10 years or 30 years, especially with 10-year, being able to lock in a 10-year or a 30-year around 5%. Money market accounts are liquid. The money can be moved at a moment's notice with a click of a button. CD ladder, which I have, can't do that. T-bill ladder, you can't do that. So that makes me believe that you have capital that has just been hanging out in a money market, trying to go the T-bill and chill methodology. Some people sat out because they were unsure, and their philosophy was, I'll just get back in when the dust settles. But as most people understand, it's very hard to time the markets, and a lot of people miss that. Other people said, I'm investing for income. I'm going to hang out on the sideline because there's zero risk. And I get that. When you can generate 4 or 5% on the sideline at zero risk, there's much less incentive to take on single stock equity risk, especially if you're going to be generating 3 or 4% dividend. Why would you generate a lower yield and take risk on when I can get guaranteed yield that's larger with zero risk? So you create an environment where it was very lucrative and enticing to sit on the sidelines. Now you have a situation where rates have been dropping. The Fed was very clear that the door is open for another rate hike, but based on the individual assessments that everybody at the Fed level took in September, it looks like 4.6% Fed rate is where we're going to end in 2024, 3.6% in 2025, and 2.9% in 2026. If that changes, who knows? But the Fed is basically telling us that there's going to be 3 cuts in 2024. If they do, 25 bips a cut.
Yep.
Now, what does that mean? That means that hanging out on the sidelines is not nearly as enticing as it once was, because once the Fed starts, you don't know if they're going to go down as quick as they went up. You don't know what they're going to do. Most people are going to want to front run, I would think, and I think you're going to see 2 trillion come back into the capital markets. I think some people will gravitate toward growth because they're going to have FOMO, and they're going to be like, oh my God, I missed the rally. Amazon's up 80%, Meta's up 150%, Google's up, or Alphabet's up 80%, 90%, Apple's at 190. I need to go in growth to try to catch up because I stayed on the sidelines. I think other people are going to try to recreate the yields that they are accustomed to getting now. And they're going to be looking at mid to high single digit yields because they're accustomed to 4 or 5%. And you may have investors with the line of thinking. If I'm going to move from risk-free to risk, I want to get paid for it. They may be looking for that 6 to 10% range. And then on the other side of it, what happens when rates decrease? Cost of capital decreases. What happens when cost of capital decreases? Businesses take loans and issue debt to fund expansion. And business expansion happens when rates are lower. We saw when rates went up, business expansion stopped. Everybody got scared. I heard more people talk about free cash flow than I've heard in the past decade, something that I've been talking about for God knows how long. Not many people used to talk about it. It's all you heard about in 2022 when growth companies were free falling. And businesses will expand during a low rate environment. They're more incentivized to. What happens when that occurs? Oh, you need more offices. That means you need more electricity. You have more vehicles, means you need more fuel. Our energy utilization will probably go up. All these things are good things for energy transfer. And I think it becomes a very interesting play in this environment for the simple fact that pipelines create dividend streams into your portfolio continuously. You look at something like Enterprise Product Partners, 26 years or 25 years of annualized dividend increases. You look at Enbridge, 29 years dividend increases. Energy Transfer is back to where they were. They're actually above where they were. It's over a 9% yield. I mean, these are things that we need. I mean, somebody is more likely to cancel a streaming service than not pay their electricity bill. So when you think about a possible recession in 2024 or 2025, I do not think we're going to get a recession in 24. I've been very clear that the number one indicator, I'll debate anybody on this because I go by facts. The facts are that an inverted yield curve is not a perfect measure. While it has a winning percentage, most of the time, it is not definite. What is definite since 1948 is every time that unemployment has increased by 1% or more, we have gone into a recession. A recession has occurred as that has occurred. We are not there. We were headed there, and the last number went down by 0.2%. Went from 3.9 to 3.7%. Now, if last month's reading becomes an anomaly, different story, because we'll be back on our way to that 1%. I believe we went from it was either 3.4 or 3.5% unemployment in June to 3.9% in October. The November reading was 3.7%. We need to see if that 3.7% was an anomaly. But even if a recession occurs in the second half of 2024, which I think is less probable than it occurring in 2025, people are not going to stop using oil and gas. And while consumer goods may contract a bit, I don't necessarily think production of those goods is going to contract much. And this is, I don't like saying recession proof, but it's pretty close to recession proof, these companies, because it is something that's needed. You can't not use these products.
Yep. No, I mean, I think it's evident, right? I mean, I think we just got to a point where renewables are north of 10% in terms of, and I guess if you collect it with nuclear, it's closer to 20% of the U.S. grid, but majority of which is still natural gas. I think that has taken over coal at this point, and then coal's obviously up there still, but declining pretty rapidly, and oil is staying there. So everything that's continuing to decrease, it's basically just offsetting the coal at the moment. And I think natural gas is continuing to grow as one of the largest uses of electricity in the United States. So I think you're right. I think this is not going to be something that goes away overnight, like many people thought was going to happen in the 2020 timeframe. But I'm also with you with respect to, I think that the Fed, even though there could be polishing, and I talked about this with Crossroads a pretty good bit yesterday, there's poking that we could do and polishing that they could have done about how quickly they moved and everything. But I think in all reality, they've done a pretty good job, even though we might not have liked the speed at which we have gotten to in a federal funds rate. I think it's done its job with respect to doing and getting inflation back down to something more reasonable and tolerable for the extended time period. And even if they do decrease, I think 25 basis points is a good place to start. And they do that at pace. I think they've done a good job. Whereas what we've been used to over the past 3 cycles for these increases and decreases has been, well, 2000 to 2001, let's just make everything, zero interest rate policy, then slowly ramp it up from, 2002 to 2007 timeframe. And then, whoop, let's go back to zero again. And then same thing with when they were trying to ramp it open again in late 2018, and we saw that negative 25% impacting the market in 2018, and then they went it back down to zero again with the pandemic. So I think we're so used to these extremes of starting to raise and then back to zero, starting to raise and then back to zero, that if we do get to a place where we're hanging out in 2 years time in the mid to low 3 percentage point range, it'll be quite an accomplishment, because at that point we're not going from a 0 to 5% back to zero, 0 to 5% back to zero. We're going to a thing that the Fed can actually do, which is tighten or loosen the collar as they see expected to make sure that inflation kind of stays at a steady pace. So I think for now, right, I might regret saying this in 6 months to a year, I think that they've done a very good job. Yes, they could have done some polishing, but I think overall, I think we're in for a softer landing than I think most people anticipate. And I'm a fundamental believer that we were in a recession last year, right? The numbers pointed to it. Like you said, everybody was so concerned about cash flow and everyone was all about efficiency, efficiency, efficiency. And look what it's done to profits for Google and Amazon and all these guys starting to focus on, oh, we need to find the fat in here, and we think we'd find 6 billion of excess. And look, the cash flow from operations of Amazon is skyrocketing right now, and I anticipate it's going to continue as we report fourth quarter earnings. And so with that, I think it's going to be a good 2024 run personally. But I appreciate your insights with respect to what you think is going to happen for ET and many other companies like it.
I'm actually reading the chat right now, and somebody asked who the next president of the United States is, and I will tell you just how the economy will grow, retrace. It doesn't matter. Like, I don't understand why people continuously have this debate. The economy grows under both political parties. People disagree with political party statements and political party ideas, but you can't say the economy doesn't grow under either one. I mean, it's just facts. I mean, oil and gas was supposed to be demonized under this administration. It hasn't been.
Yeah. It started off that way, right? They started off that way with
but talk is a lot. Look, okay, one of the pipelines got axed. Okay, but what has happened? I mean, the production keeps going up. Yeah, you got states that have a harsher stance than others, but we're still producing more oil and gas than ever. And at the end of the day, from an overall economy aspect, economy's still growing. Look at a long-term chart of the market. It goes up under both political parties. People get too fixated on that. Goes up under both political parties.
Yep. Yeah, generally speaking, every time it changes hands, there is some sort of recession under most presidents. But you're right; most of the time it goes up and to the right for both parties, and
because companies get more efficient, companies make more money, and we have larger population. You have more people and more businesses spending money. That is a recipe for up and to the right. Yeah, you're gonna have dips. Yes, you're gonna have recessions. You're gonna have corrections. You're gonna have crashes, but you're also gonna have bull markets. And over time, it hasn't mattered who has controlled the political landscape. The markets overall have gone up. So could the markets crash? Absolutely. But if you're a long-term investor, I mean, look, I can't predict the markets from a day-to-day basis. I don't try. And if you sat on the sidelines waiting for the dust to settle in 2023, you missed a huge rally. I mean, there were, and look, there were a lot of chances to get back into the market, yet cash in money market accounts just grew. What does that tell you?
Well, no, I do hear what people are saying. Some people are saying, the Keystone XL pipeline, the leases that are trying to be barred. And right now, we just had a successful lease sale this morning in the Gulf of Mexico, lease sale 261. $380 million of revenue was generated for the U.S. government. So hopefully those leases will be awarded. But that's the last one until 2025 because they're not going to do any in 2024. So we're curious, normally they do twice a year. They kept trying to fail to award some of the ones that were done in the March timeframe. That got overturned. And then we just had a successful one here in December, even though it was supposed to happen in November timeframe. So it so far, you're right. It's been okay from a regulatory perspective. There were some scares for us because I work deepwater Gulf of Mexico. Like, are we going to be barred? There's a lot of leases that we were looking at picking up.
You got to look at it like this. You got to look at it logically. Okay. The logical stance is unless there is an alternative to oil and gas for sustainable, not just energy, sustainable energy. Nobody wants spotty energy. Oil and gas is still going to be here. We are very far off unless there are significant breakthroughs in technology.
Well, I don't think it's just that, right? I mean, even this system that we've been, using, we think it's so easy, but it's been developed over the course of over 100 years. And so it's very easy to say, and so that ease of convenience and that convenience of having it be developed over the past 100 years makes it easy to continue to use and cheap to continue to use versus something like a renewables where you're forced to have to continue to invest into it and develop it over the course. It's like, it's going to take time, just like it took time for the ease of use that we're at today. We take it for granted because we're like, this is all I've known for my entire life. But you have to think, even before either of us were here, it was still around for 50 to 70 years before either of us, right? So it's easy for us to point the finger and say, we need to change. But, it's going to take decades for that infrastructure to truly be put in place. And so I'm not saying I'm against it. I'm just saying, like, it takes time for these things to be developed over time. And hopefully people recognize that patience is necessary. And not only that, but it's very easy from a Western focused society where we're a much more mature economy to be able to point the finger and say, we need to do better, right? Versus somebody that's living in Indonesia where there's literally thousands of islands. And same thing with like a lot of Southeast Asian kind of islands that are out there. It's very difficult to get some of these wind and solar utilities spread across all these islands and being used across multitude of islands. It's much easier to transport oil, right? And so it's easy for us to point the finger when we have this large continuous body mass that spans 3,000 miles in one direction and 2,000 in the other. And we have the ability to transport across all of it. Yes, there's a regulatory environment, but like we've had this infrastructure that's been developed over 100 years and we're taking advantage of it versus all these other countries. Like think of Africa, for example. How easy do you think it would be to transport solar energy from one country to the next? Very difficult and also very large landmass. So it's, what's easier to do is transport a liquid, which is oil, and to be able to move things around that way. It's going to be very difficult to set up wind farms and solar farms and have to deal with multitude of different governments. So anyway, just some food for thought for there. We're very spoiled. We are able to think of things, and like as if we're one united state because we are. And same thing with the EU. Most of the time they make decisions unilaterally as an entire conglomerate of countries because they've signed up that specific MOU, memorandum of understanding, to be like a legit united European Union. So it's easy to transport things across country lines. It's not as easy for the rest of the world. India doesn't always communicate well with China. China doesn't always communicate well with India. Russia doesn't always communicate with either of them well either. Although Russia and China seem to be allies, it doesn't mean that they're going to be able to willingly accept wind energy from China going into Russia or vice versa, right? But for some reason, these channels of oil and gas trade have been set up over the course of the last century. So it's something that's much, much easier to kind of rely on.
I agree.
Cool. All right. Well, let's call it there. There's some people asking about nuclear. I know Chris wants to be involved in that conversation, but as always, Hot Steve, do you have any other companies that you want to bring on next week, or are you around next week? Are you taking off?
I'm around. Somebody asked my opinion on XRP, and they actually have XRP in their title. I think that's great.
There you go.
I can give you a very quick synopsis if you want to hear it, Matt. Are you a crypto guy?
Sure. I'm more of a Bitcoin guy personally, but XRP, I understand the use case for it.
Yeah, I mean, I'm not a crypto person, but I am an XRP person. I'm going to get a lot of heat for this, but I don't care. I don't think Bitcoin has a use case. I really don't. I think that XRP is going to be the one ring that rules them all. I like the idea around the smart contracts with Ethereum. Don't know exactly how that's going to go, only because not many companies are probably going to be willing to lock up 100% of capital in an escrow and have it release at certain times. That's just not how business normally works. XRP solves a huge problem. You think about, I think the numbers 5 trillion moves through the SWIFT network every day. Around 5 trillion gets moved on a daily basis through the SWIFT network. And when you think about the SWIFT network, this was set up, I think, in the 70s. And if you're moving, like if I was to move money, I think, Matt, you're in Texas, you're in Houston. The quickest way for me to move 10 grand to Matt would be for me to fly it there. Like that would legitimately be the quickest way for me to get on a plane and fly it to Matt and hand it to him. He'd have it within 6 hours, 7 hours. I could transfer it to him, but he needs to wait for it to settle. You try sending cross-border payments, you have intermediary banks, you have different financial institutions that it has to go through, that they have to take a cut, there's higher fees, and it's just slower. XRP settles in 3 seconds. So I can send somebody I can buy XRP in USD. I can send it to somebody in Japan. It'll settle within 3 seconds, and then they can extract it for yen immediately. Yeah. I mean, I think it solves a huge problem. I think it is quicker. And you look at the partnerships that Ripple has with these different banks on a global scale. If we move to a full digital currency, or more of we're already becoming a more digitalized globalization at this point. I really do think that if crypto really is going to do something, it's going to have to solve a problem and not just be a store of value. And sure, Bitcoin will probably always be there because it is identified as everybody as the gold standard of internet gold. You can send a fraction of it anywhere. I get it. But it's only worth something if somebody's willing to pay the asking price for it. It's greater fool theory. Like, other than a store of value and other the perception of it being worth something, Bitcoin does not solve any great utility because the throughput is not nearly as much as XRP, and the settlement time, I have it here, is it takes 3,600 seconds for it to settle, which is 60 minutes. XRP takes 3 to 4 seconds. Like, it's not going to be a mass production. And I don't remember the throughput, but I have read that it is significantly lower than Ethereum or XRP. I mean, from a crypto standpoint, I'm not a big crypto guy, but I see the use case and I see the potential for an XRP being used more in the banking sector. And we'll see what Brad Garlinghouse and Ripple can do. I mean, I have no idea what it's going to do. It could go to zero, but at least from my perspective, it solves a problem. And if it captures a portion of what is going through the Swift network, it's going to be very interesting to see what happens with the share, with the price per XRP. We'll see.
So I guess my question is, like, I don't disagree with what you're saying with respect to being able to settle faster and everything the like. I guess my question is what truly makes XRP that much superior, right? If you're going from a 3-day settle time to a 4 to 10 minute settle time using Bitcoin to a 4 to 10 second settle time for XRP, like, what is the real true benefit? If it's that much of a magnitude of difference, right? I get 4 seconds is greater than 4 to 10, but why does that absolutely make Bitcoin obsolete? I think the part of the benefit of Bitcoin being like is that there's no CEO directing X, Y, and Z.
I get that, but I'm going to give you the answer.
Yeah.
So Bitcoin has a 60-minute transaction settlement time. Okay. How much has Bitcoin fluctuated in 60 minutes? So let's just use easy math numbers. Let's just say it's at 50 grand, okay, which is more than what it is now. I'm using more on purpose. Let's say it's at 50 grand and I'm going to send you 1 Bitcoin because I owe you 50 grand or I'm buying something for 50 grand or I need to move 50 grand, okay? In that hour, is it unreasonable that Bitcoin could be worth 49,000 or 51,000? Pretty reasonable that it could be worth 49 or 51 instead of the 50. I mean, the fluctuation in that hour could be up or down. It's probably not going to stay the same.
So you're saying a 2% fluctuation?
It could be more, it could be less. I'm just saying that everything's going to fluctuate.
Because I'm just saying, I'm just looking at it today. It fluctuated around 61 cents. At one point, XRP went up to 62.5 cents and it went down to 61.8 cents. That's about a 2% fluctuation. It's
right. But Bitcoin with a 60-minute settlement time and XRP with a 3 or 4 second, your risk mitigation is significantly less with XRP from a unit price fluctuation.
Let's see what you're saying.
So if I'm going to send you something and I owe you money and I'm going to send crypto, I'm sending you something that when you get it, you can extract it immediately. If you have to wait an hour, Bitcoin could be down $500, which isn't a huge move down, but it's still less than what I owed you. But at the time when I sent you what I owed you. At least with XRP, you get it on your phone, you transfer it, you're good. Transfer to USD, you're good. Happens immediately. So that's where I see XRP having a huge leg up on everything. And I know Solana has huge throughput and settlement time is roughly the same as XRP from what I've read, but it doesn't have the partnerships, to my knowledge, that XRP has. I could be wrong. I haven't done the research on Solana that others have, but XRP has the rails, they have the partnerships, they have the settlement time. We'll see what happens.
But I guess the question is like, why do we have to wait 6 confirmations, right? Why isn't 2 or 3 confirmations sufficient enough for Bitcoin? That would literally drop the amount of time to wait from an hour to a half hour, right?
No idea. I think it's the code that it's written. I don't know. I don't know if that's what Bitcoin was built for. Like, this is what XRP was built for. It was for cross-border payments and going after the Swift network.
Man.
Like that's the big difference. Like, this is what it was built for.
Yeah, I mean, I think it all just depends, right? I mean, what are you looking for? And that's another piece, though. Like, if you think that going back to what you're talking about, if you think XRP is so stable and it's not going to change in value, then why invest in it in the first place if you think it's just
I
going to
didn't
hang
say it
out?
wasn't going to change in value. I said in 3 seconds risk mitigation. And I think that so my thesis is I'm willing to take a risk and own a certain amount of XRP as a just in case. Like it is a lottery ticket. Let's be very clear. It is a lottery ticket. But if it gets the percentage of the Swift network that Brett Garlinghouse is going after, and if the banks start utilizing it the way that they may, okay, the value of this could increase to support the throughput going through the network and could increase the value of XRP. Now, I think that there could be very big upside potential on this, and that's why I'm willing to invest. I could be 100% wrong, but to me, I don't see Bitcoin as a store of value. It is a store of value, and I'm willing to say that because it certainly is, because people are willing to pay a certain price for it. To me, Bitcoin doesn't really solve a problem. XRP does, so I'm willing to roll with it. We'll see what happens. And yeah, I Bitcoin is the biggest mistake of my life because I was trying to figure out how to buy it when it was $8 a Bitcoin back in like 2011, and Mt. Gox happened. And I'm like, yeah, fuck this. I'm not doing it. Not interested. Don't want anything to do with it. It was the Wild West. There was no Coinbase. If Coinbase was around or something like that, I would have bought it. But missed out. It is what it is.
All right. Well, I understand where you're coming from, and I understand the cross country settle piece because I lived in Trinidad and Tobago, and I saw a lot of that issue kind of happening where it's very difficult for people to, let's just say, convert Trinidad dollars to US dollars because there's 4 big companies in Trinidad that use 80 to 90% of the US dollars that are used on a day-to-day basis in Trinidad are concentrated around those 4 companies. And so I got it. I understood, the supply constraints associated with being able to move things from one currency to another. And so having something like an XRP or a Bitcoin or anything like that is very useful for those folks because instead of having to go directly to, you can digitalize it, right? I think in some places in the world, you still have to go from cash to cash. And basically they won't just like inject your account with US dollars digitally. They actually have to give you the physical cash. So, I get it in that respect. It makes things a little bit more digital. It allows you to kind of transport, cross borders. But to me, I think from a long-term hold perspective, I would say Bitcoin is probably the one that is going to do better, right? I think that the benefit of an XRP is
I think people are going to do really well on Bitcoin. Yeah. I can completely see it. I can see it eventually going up, even if I don't agree that it is worth anything. I completely see it, and it is worth something because people are willing to pay this price for it, so it's worth this price because somebody's willing to pay for it. Now that's the difference between me and other people. I can at least acknowledge that it is worth what the fair market value is, and currently the fair market value is what, 48,000, something like that. So
yeah, I just acknowledge that more wealthy people that I know, and also celebrities and large financial institutions are moving to Bitcoin. To me, they're moving to Ripple for transactions, right? Not from a long-term appreciation perspective. Maybe I'm miseducated on that, and maybe I'll eat my words in 5-10 years.
There are people that are investing in it because they think that the utilization is going to go up, which is going to drive the price up. And then I think institutions are starting to use it because it is cheaper than sending a wire and it is quicker than sending a wire. Yeah. So I think there's 2 different camps and 2 different use cases.
Yeah.
You look tired, dude. You're on the West Coast. You look tired.
I'm on the Central. I think it might just be the light. I don't know. Maybe I always look tired. I don't know.
You need to start drinking some more coffee.
I did not. I actually did think about that. So for you, I don't know if you're into the iced coffee or not. But I'm used to at work, because I don't, I've been living in an apartment. I've always known I was going to move. I've always been thinking about buying a coffee maker, but Starbucks actually sells their iced coffee at the grocery store, and you can buy it for like $4 or $5. And it's probably, instead of getting like 2 or 3 iced coffees, you probably get like, I don't know, 8 or 9 or 10 cups of iced coffee out of that instead.
There is a
So
point during the year where my body tells me I want iced coffee, and that usually lasts for like 3 weeks. And it's usually sometime during July into August. And then I
mm,
go back to hot coffee. And I end up buying way too much iced coffee, put it in the fridge, and end up getting rid of it. Um, but yes, iced coffee is absolutely delicious. It's just not a, I don't know. I am hot coffee dependent.
mm. There's nothing wrong with that. Nothing wrong with that. Do you do Dutch Bros? Not at all. Is Dutch Well,
We don't
Dutch
have one
Bros.
here.
Yeah, you don't have it yet. You will. You will.
No.
You will.
No, I was actually thinking about investing in it. I need to do more research on it. I watched you and Chris break it down. I've seen you break it down, and I think about mass market adoption. Can this become the next Starbucks or the next McDonald's or the next Chipotle? And I am unsure at the moment.
I still think it's either, it could go 50-50. Like, I don't know. Some of the drinks I've had are like, I wouldn't get that one again. I had another one yesterday where I was like, this thing does this great. Like, I had the Merry Mischief. It was one of their holiday things. Actually, I had 2 things yesterday. Both were great. I got a small peppermint or something. Um, was it a nitro cold brew? And that thing was phenomenal. And then I did the Merry Mischief Rebel, which is their energy drink, and that thing's phenomenal as well. And the thing that I still regret, because every time I go, I get something that's like energy or coffee related. I have yet to get anything that's like an iced tea or like a lemonade or a Dutch soda. That's a lie. I did like a Dutch soda or something one time, and I was just like, man, I wish this was a little bit stronger. But I forget what it was. I did not choose wisely in my decision. I think I chose something that was way too light. And I
I'll tell you,
wanted something.
I'm not a coffee snob by any means. Just give me regular coffee with a little bit of half and half, and I'm good. As long as it's not like water, I don't discriminate. I'll drink Maxwell House. I'll drink Starbucks. I'll drink Folgers. I'll drink Pete's. I don't care as long as it has caffeine and it tastes like coffee. Yes, I have some brands I prefer over others, but as long as it's coffee, I'm good. Just give me coffee with half and half, and I'm good.
Yeah. Well, the thing I like about the iced coffee, you can get it from the grocery store with the Starbucks. It's like this big of a container. One, you can get a lot more of it, and then 2, you can get it unsweetened or sweetened, and the sweetened isn't too sweet.
Yeah, I don't do
So
sugar in it.
yeah, either do I. But like, this is enough where it's just like, okay, that's really really tasty, but it's not overpower. Like some people just like I've seen my aunts, uncles, they throw so much milk and like, and I'm just like, my guy, like I'm drinking it for the taste
The only thing I'm
of the
drinking
coffee.
black is espresso. Unless it's espresso, I need some half and half in there.
Mm. Hot Steve, man, I'm telling you, the myth, the legend. All right, well, I appreciate you coming on. Hey, I do have a serious question, and I actually was thinking about this, especially if Chris and I go to 5 days a week in the future. How often would you want
I
to
thought you guys
potentially?
do 5 days a week.
What's that?
I thought you guys do 5 days a week.
We do 3 days a week. I generally do more. I generally will do at least 1 or 2 more streams a week. I also do Palantir Weekly and stuff like that. But Chris does Finance Junkies 5 days a week, Sunday through Thursday, and then we do Cashflow Chronicles Tuesday through Thursday. And then I do Palantir Weekly. Chris will sometimes show up for Palantir Weekly, but lately he hasn't since Finance Junkies have taken off and Cashflow Chronicles has taken off. So he's getting his exposure there. But my question to you is, I'd love to have you more often. I know you do a lot of Seeking Alpha content. And so specifically around earnings times, if there's ever a company you want to cover that is releasing, just let me know. And I'd love to, I'm trying to figure out a way to make sure that we always have an action-packed conversation every single night. And so, during earnings, it's very easy.
I said
right?
you look sleepy, and now I'm starting to yawn.
Dude, I'm sorry.
But yes, I can be available. Usually Monday and Wednesday nights are good for me, and over the weekends.
Over the weekends. Okay. You
Yeah.
said Monday or Wednesdays?
Wednesday. Yeah, those nights usually work the best for me.
Okay, cool. All right. Well, if you're in town next week, I'm not guaranteeing because when's Christmas? Is that Monday or Tuesday? Monday. Okay. Well, sometime next week, I'll have to talk to Chris about when he wants to stream because I know he's probably going to see family as well. But I'll be at least doing something next week. Will I be fully full schedule? I don't know. Whenever you're ready, do your DD on Dutch Bros. Some people, specifically Money Gang members, are curious to hear your thoughts. And
I'm typing it in right now.
All right. Okay. Well, don't stress yourself out. But yes, I'm curious to hear your thoughts and let me know if there's any other articles. You're writing at least 1 or 2 articles a week, so you got plenty of content. So
yeah, I mean, I try to do 4 or 5 articles a week.
You do 4 to 5?
Yeah.
You're out of control. I don't know how you and Chris do it. Like Chris wrote his 2 Patreons. Shout out to Chris's Patreon below. He in the description, make sure you guys check it out. He's going to raise the prices starting in January. He wrote like 2 articles like last night. I got notifications from his Discord.
So
I don't know how you guys do it.
I'll write an article on Friday night before SoFi Weekly and schedule it to come out on Monday. And then I'll usually write 2 more articles over the weekend. And if I don't get to the article on Friday, I'll write 3 articles between Saturday and Sunday. And I'll schedule them to come out Monday, Tuesday, Wednesday. And then usually Monday and Tuesday or Tuesday and Wednesday, I'll write an article. No. So I have Monday and Tuesday covering, then I have a Thursday series about dividends that I write. Monday, Tuesday, I'll usually write an article for Wednesday. And then on Thursdays, I'll write an article for Friday. So I usually have an article come out every day during the week.
You're an animal.
Try to be. I got to tell you, Dutch Bros is very interesting.
We'll see. We'll see.
No 91 million long-term debt with 150 million in cash on hand. That's very interesting.
Do they not have more short-term liability? I thought they had more short-term liabilities.
I'm only talking about debt, not capital leases or anything.
Okay.
The only thing that I'm not liking is negative free cash flow, but that could be because they are opening a lot of places and have huge capex. But obviously, I like that they're cash flow positive from operations, but
yes,
capex.
I think the biggest problem right now is that people are seeing that they're overspending their capex, but I think that's a recent thing, and the pace at which their EBITDA is growing. My hope is that the 4th quarter of next year, they're actually going to start to see a quarter where they're outpacing capital expenditures. But so I'm curious.
Here's my question about it.
Yeah.
Is the Dutch Bros brand, and nobody can answer this because only time's going to tell, is the Dutch Bros brand going to get to a point where it is in every Walmart, every Target, every Kroger, every Stop and Shop, every Costco?
I don't think so.
And sold through Amazon, because that's the play.
I don't think so. And I think the reason being is at the moment they want to make sure the problem that I see is going to be the benefit short to medium term, but potentially it's problem in the long term. And that is they want to hold a lot of their current employees as future owners of future stores. But they're not franchising as much as they used to. So they used to be like a franchise model. So there's some franchises that are on the West Coast, but there's no franchises in Texas. There's no franchises in Tennessee. Those are all company-owned stores. And so they're big about, which is it makes it a very strong brand, but sometimes you need brands to change depending on what location you're in, right? So not all brands will do well. So I think in the short term, those brands have been well received on the western half of the United States to Texas, maybe to Tennessee. Will those brands mesh well if you get to the East Coast? I don't know. I don't know what the answer is.
So somebody said that Dutch Bros has 645 million of debt. Yes. For total debt, they have 645 million. I'm not talking about total debt. I'm talking about long-term debt, because in debt is capital leases. That's an operating expense to me. So I'm not considering that as necessarily debt that needs to be repaid from a bond. That is a capital lease, two different things. Even though capital leases are considered debt on a balance sheet, it's not true long-term debt that would have a debt maturity on it.
And there's another thing, is like the company's growing. So the fact that you're like already trying to put a price to earnings multiple and all these things on it, they're always going to show poor numbers until it's a more mature company, right? So like they just got to profitability because of their pace of expansion within the last 12 months. So the fact that you're already trying to put a price to earnings, you're going to show poor numbers.
Look, the thing for me really is that direct to consumer, vendor VDC, vendor direct to consumer, for the simple fact that you're buying this wine to make money. If Dutch Bros has a huge brand around them, they need to sell ground coffee in these retail outlets to maximize their brand, have it in everybody's faces all the time, and create another line of revenue. Because not everybody is going to go to a Dutch Bros.
Yeah.
And that's the biggest thing. Like, are they going to compete with Starbucks and Dunkin'? I can buy either one of those in any supermarket, you know? They got to get into that segment. That's where a lot of this growth is going to come from, because that's not that capital intensive.
Yeah. I think the current reason why it's trading at the valuations it is you know, the EBITDA, I think they're going to end at like 125 to 150 this year. I think that's where they're at, but they're spending 225 to 250. So next year, I think that they're going to get closer to 190 million in EBITDA. And if they're still spending 225 to 250 next year, I think by the time all the stores come in the fourth quarter, you know, those generally speaking add a crap ton of money. Their operating costs or gross profit for stores is like 30 to 35%. So they do a pretty good job with that. And that's on pace with Starbucks as well. So I guess it all just depends on how much you can keep the overhead down. And that's where you're going to be truly hoping to kind of make the big money. So I'm thinking that they're going to grow to be like a 1.2 billion, 1.25 billion revenue organization next year. That's like a 25 to 30% growth rate. I think they're going to end up at like just short of $1 billion this year.
The thing is, the float is so small at 75 million shares, and you have not a lot of debt, and you have 14% short interest. This is so interesting, because think about this. And the margins are not great right now by any stretch of the mind, but if they become significantly more profitable, and if they start buying back shares, this thing could explode. But a lot of things have to go right. And for me, it's like Dutch Bros is interesting, but there's two other companies that I would be way more bullish on from a growth aspect. And then where am I going to make the most money? At this point, I haven't done enough due diligence, but I still think SoFi and Palantir are better bets for me at this point. I think that there's some other things I'm very interested in that are going to do well in 2024. Dutch Bros is a complete spec for me at this point. I'd have to do a lot more, but if I felt that the brand was going to really grow, I think now is a very interesting time, because you look at what Starbucks has done, you look at what Dunkin's done. I mean, could Dutch Bros become a $50 billion company? Maybe. Like, do they have the potential? Maybe. I don't know. You're going to
I
need
think
about
that's
10 years
tough. I
to figure
think
it
I
out.
would say where I'm looking now is it potentially on the high end, and maybe I'm short sighting it, is I think it could grow into a 20 to 25 billion if they continue their pace, right? And I think that 50 billion is stretched, right? Starbucks is the creme de la creme, competitor directly in the space. So, I mean, and then again, you're talking about it growing into this valuation 10, 15 years down the road. So if that's really the case, are you talking about more like $180 billion market cap because of
I'm
inflation and
looking
stuff
at
like
a
that?
5 to 10 year hold with a growing population, and coffee is the biggest legal drug.
Yeah.
If Dutch Bros can crack the market, maybe it can 5 or 10x.
Yeah.
But I'm not investing money in Dutch Bros for a double. If I'm investing in Dutch Bros, I'm investing because I think it's going to be 5 or 10x. There's too many other companies out there that can be a double.
Well,
For
I
me to
think that if
allocate,
that's the case and you get around, I'm looking for a 4 to 5. I don't think that 10x is reasonable here, but if you think so, then
no,
let me
I'm not
know.
saying I do. I'm just saying that.
Oh, okay, I see what you're saying.
Like
That's what you're looking for.
what I'm saying is that I think SoFi is a 5 to 10x over the next 5 to 10 years.
Yeah.
Okay. For me to allocate more capital to growth, something would have to be more compelling than SoFi to me. I haven't done the due diligence on Dutch Bros, but for me to allocate money to Dutch Bros, my investment thesis would have to get me to where I believe the Dutch Bros would be a $50 billion company,
Yeah.
that area in the next 10 years. 25 to 50 billion, because that would be a 5 to 10x. I would not be willing to invest in Dutch Bros for it to double when I think that SoFi could easily hit 18 in 2024. Because 100% is 100%. It doesn't matter if I invest in ABC or XYZ. So if I think that SoFi can hit 18 in 2024 and Dutch Bros is only going to go to 35 or 40, my money's better put in SoFi. So I have to do more due diligence, but this is a play on commercial,
Yeah.
to play on a subscription model for coffee. It's a play on supermarket, not just physical retail. And if they're not going to get that market, this is a pass for me, because I don't see them scaling into a big enough company with the competition that they currently have. Because look, McDonald's is a competitor.
Yep.
There's a lot of competition in the space. For them to really do what I would need them to do, they got to get into supermarkets.
Yeah. No, yeah, I think, I'm just doing some quick math, and this is very aggressive, meaning on the high end. I mean, they're currently averaging in terms of unit volume, 2 million per store. Their goal is to get to 4,000 stores. That's 8 billion in revenue, right? Even if you walk away with a 15 to 20% net margin, which is kind of likely on the higher end, but that's around, I think Starbucks walks away with about a 19 to 20.
Here's the question. For them to get to that many stores, how are they funding that? Are they issuing more shares and diluting shareholders, or are they taking on debt?
So what they did recently, this is the thing. Eventually, I think that they'll be able to self-sustain. At the moment, what they did this year, they did it a couple months ago, is they issued about $300 million in stock.
Yep.
So like 8 to 10% dilution of the stock to be able to get capital that funds about a year and a half's worth. And at the moment, to me, I think that that's sufficient to get you to a place where you are funding enough to where the EBITDA is going to catch up. And then eventually, once the EBITDA catches up within the next year and a half, 2 years, you'll be able to self-fund going forward. But because right now you're running at a deficit of 100 million. Next year, you're going to run at a deficit of less than 100 million. It's going to be closer to 50 million. Then the year after that, you're going to have way more stores opening up. So unless they increase the capex to 300 or 350 million a year, then I think in the next 2 years they'll be cash flow positive. And then at that point, do they increase the amount of stores that they're opening per annum to match that cash flow break even point? I guess is my question. But I think with respect to a lot of people also asking about Cosmix, is Cosmix going to take over? Cosmix has one store. We're in 2023. Next year, the Cosmix is the McDonald's spinoff.
Yeah, they started with 13 stores or more.
Yeah, next year they're going to 10 or 13 stores, most of them concentrated in Texas. So it's like, okay, well, then at least you're talking about 900 stores versus 13. I get it. There's competition coming. And
There's so much competition for Dutch Bros.
There's a lot. But at the same time, it's like if you're worried about Cosmix and Cosmix only, you have until about 2026, 2027 before you really need to worry.
So, Matt, you've been to NYC, right?
What's that?
You've been to New York City, right?
Yes, sir.
You can't walk a block without going to without a coffee place. Whether it is a chain or an independent, I mean, there is legitimately a coffee store, not a cart on the side of the street, a actual
Zor Blue, who is a prominent Wall Street analyst that is likely a quadrillionaire, does not like Dutch Bros.
Yeah, I mean, I truly think that there's so much competition that I would be very hard pressed unless I saw something in reading the 10K and doing the numbers and looking at everything that made it compelling to me. I just think about it. If Dutch Bros was somewhere in New York City, there's so much competition, and Starbucks is all over the place. Dunkin' is somewhat all over the place, but there's so many independent places. And then I think about driving around Jersey and New York and whatnot, and I don't know. The market is very saturated. For me, the more I think about it, they would need to have that product in the stores for me to really feel like they could really expand to the point where they're making enough money where they can buy back shares and generate value for shareholders. I just don't know that model that they're in with the competition is really going to be there. I don't know.
I hear you, man. I think it is a tough market. It's been successful so far here in Houston. They're getting about 2 million per store, and they're continuing to see. They're starting to see some infill creep, though. Obviously, when you're putting stores within a close vicinity of each other, you start to lose competition of your own stores as well. So,
it will be interesting to see what happens over the next couple of quarters. But there's just I think Palantir for me. There's so much more potential there.
I can see it.
And for me, there's more potential in SoFi. To me, those are my two growth horses right now. They have been. That's not changing. There's nothing that makes me shy away from my 5 to 10 year thoughts and investment thesis on it. And no, I'm skewed toward big tech. I mean, I got Apple, Meta, Alphabet, Amazon, and I became a shareholder of something today that I'm going to announce on Finance Junkies at some point. But I have a big allocation on tech, so tech's done pretty good. I think the big companies are going to keep going up, and I think SoFi and Palantir are going to do pretty good. So,
is it Rocket Lab that you bought? Is it Rocket Lab that you bought?
It's not Rocket Lab, but let's just say I am acquiring shares of a company with other people's money because I'm selling a boatload of covered calls on certain positions, and all that premium is buying shares of something. And I am going to acquire my full position with other people's money over a period of time.
Interesting.
I do think PFE is very interesting, but it is not that. I'm already a shareholder of PFE.
Yeah, are you a shareholder? I was going to ask because Chris and I looked at it and we're like,
I told him to look into it. I called him. I said, you need to look into this now.
Because I just don't know what the pipeline looks like, right? I mean, I know they have obviously what happened with the pandemic and they were able to get their vaccine, but that's obviously rolled off. But I'm like, why is it dropping so crazy?
Was worried. Okay. They would not have raised the dividend again the other day. They just raised the dividend 2.6%. You don't raise the dividend for your 13th straight year if you're worried about profitability. And when you look at Pfizer, Yes, their revenue has tanked from the lack of COVID vaccines. Okay. But this is a company that in 2021 generated, or last year generated 100 billion in total revenue, and their net income was 31 billion. Okay. Anomaly. That is an anomaly year because of the surge in vaccines. In the trailing 12, they've still done 68 billion in revenue and 10.5 billion in pure profit. Huge profits. They have a pipeline. They just acquired another company. The name is escaping me. Big pipeline. The fears about the COVID thing are probably going to go away over time. And are we really worried about Pfizer not being here in 10 years? I'm not. It's Pfizer. Before whatever they're allocating toward this deal, as of last quarter, they had 41 billion, not million, $41 billion in short-term investments on the balance sheet, with another 14 billion in long-term investments. This company has a ton of cash on hand. They have a big pipeline. Their free cash flow is very big. I mean, 7.5, 8 billion free cash flow in the trailing 12 months. Dividend is currently 57% payout ratio of their EPS. Even at the lowered EPS that they came out with, which the street did not like, the dividend's $1.68. I think they came out.
Was that a non-cash item though, Stephen? Like, because that's what my immediate thought was when I looked at it. It said the operating income has fallen off a cliff and gone negative. Is that real or is that non-cash? I don't know. I'm asking stupid questions because I literally have done.
No, it's not stupid. All I saw was that I'm trying to find it right now. They came out with guidance that for 2024, saying that adjusted earnings per share to stand at 205 to 225, which is significantly lower than what they had previously said. The article's not saying what it previously was, but maybe it was 317. It was significantly lower, but still, even if they come in on the low side at 205, your dividend's still fully covered. And okay, this goes down for a year, it stays here for a year, I'll acquire shares, whatever. I'll build a position.
Well, I know a lot of people are gravitating towards it. Let me see if my internet's being garbage. I apologize. I've already called Comcast a million times, and hopefully they get their shit together because I'm canceling. But this is what I was kind of looking at with respect to the trailing 12 month. I mean, this is earnings per share, negative 42 cents. Obviously, the TTM has gone down, and we know why, right? I mean, the vaccine helped them get and balloon their EPS pretty substantially, but now it looks like it's kind of returning back to where it was, 3,
yeah, I mean,
4,
that
5
EPS
years ago.
is on one quarter.
Yeah.
And looking at the forward estimates, 2024. So let me share this.
Yeah.
Share screen. So this is what the street is looking at. I'll make this bigger for everybody. Look, the street's looking for 222 next year, and then 283, 293, 302, 310, 318. There's growth. Who knows what's going to happen in the future? But it's more than enough for the dividend to be covered for debt. I'm saying I shouldn't say that. Probably more than enough for their debt obligations. I would need to look into the numbers more. But I think Pfizer is just one of those companies that I would feel very comfortable investing in now. And it's just something that as money flows into the market, it's one of those names that's down 50% or 45% in the past year, over 6% dividend. I could see an investment thesis where capital flows into it, the dogs of the Dow methodology, and you catch a bid. I could also see them in a year from now or a year and a half from now working out some of their problems And would anybody be surprised if Pfizer was trading at $40 a share in a year or two? I don't think anybody would be surprised if it was. I mean, that's more
But
of
I
a
guess my
normal
question
number.
is like, generally speaking, when you have some impacts like this, more poop is to come, right? And it could go 50-50, right? I mean, there could be more poop.
It could keep going down. Look, it could go to 20.
Yeah.
It's not like it can't do that. It could go to 20, but that's why I'm saying that for me, it would be something that I would acquire shares in. Like if it keeps going down, I will buy more. Thank you for drinking Coca-Cola over Pepsi. I appreciate that.
Normally I'm a Pepsi guy, you know that.
Oh, really? I did not know that. Gotta break out of that. Gotta drink Coke. I can see Pfizer going down, but I think ultimately in a couple of years it'll be significantly higher than where it is today. I can build a position if it goes down, dollar cost average into it, and keep compounding that quarterly dividend that is above the risk-free rate of return. And if Pfizer goes up to 40, I mean, what is that, like a 40% increase around that area? I mean, it to me, it makes sense right now. I need to look into it more, but it makes sense to me.
Yeah. I mean, I could see something where it's like, I don't know what the put premium it looks like for a cash secured put, but it might be something where because I'm not 100% sold as of yet, it might be something that I sell a put, you know, and get a little bit further down. And if it does pull it, then I could see myself, you know, starting an opportunity where I would just be selling covered calls to get out of it, you know, pretty quickly.
Did you
But
jump
I'm not
on?
100% pull. I'm not 100% convinced yet.
Did you jump on SLG with us?
What's that?
Did you jump on SL Green with us?
Yes, but I did due diligence, right? I didn't do that blindly, right? I looked through the
So
entire 100-something page
I
slide pack
wrote
and
a lot of cover calls today.
mm.
I was telling Chris, I texted Chris as I was
Curious, what
doing.
strike?
Check this out. So they just lowered the dividend to $3 a share. So they're paying a quarter, 25 cents per month, okay, for the dividend. I wrote January 19th, okay? So that's 1 month. January 19th, $60 strike. Okay. I got paid 28 cents per share.
Why so far out of the money and
Because
not
I
just
have no interest in rolling and I have no interest in getting out of my position. So I wanted it so far out of the money. I don't think SL Green's hitting 60 in a month. And if it does, I'll be more than happy to sell.
yeah.
Um,
I'm at the February 50s right now, and I'm kind of pooping because I'm really hoping that it doesn't get called away.
yeah,
But
did
I
not
wrote
want to
those. I wrote those like 2 weeks ago, and
I
then
could have made a lot more money if I had done the 55s. I just didn't want to be that close to the money because I think the SL Green could go up more. I was like, well, maybe I'll just roll it. I don't even want to deal with it. I was able to more than double my dividend this month by writing those cover calls. And I
yeah.
think it's a cover call that's not going to get called away. So I was very happy to write it.
I've
And quite
been doing it
honestly,
since I bought it, and I've been fortunate, you know, that I'm with you. I mean, I am somebody, but like the $50 range for me is where I'm actually contemplating getting rid of some of the shares. Not all of them, but some of them, right? And taking a little bit of that money and maybe just putting it into the SPY. But I mean, it's a smaller position for me. I only have 350 shares, so you know, it's not a big position. So, but I didn't see that they cut the dividend, so I'd have to do a little bit more looking.
yeah, they did it 2 weeks ago and they're using that money. So part of the reason is they're selling, I think, 625 Madison. I
Yeah,
get
I
the
saw that.
addresses mixed up. I think it's 625 Madison. So they're selling that building. So I think the dividend cut was a combination of readjusting for the lost funds from operations and to repay debt and to be in a position to make an acquisition of assets if something interesting comes up and because they're putting their proposal through this winter with Caesars for a casino in Times Square. And if that goes through, I'm sure they're going to need capital. So we'll see
Yeah.
what happens.
Yeah, I mean, I saw that they made that announcement at the beginning of December. I didn't see that they had subsequently cut the dividend. That's upsetting, but because
It's just 25 cents. I mean, it's not a big deal.
Because it was what, 31 before? I'm trying to remember what it was.
The dividend was 3.25, and the dividend's 3 now.
Oh, okay.
Yeah, it's just 25 cents. So the monthly went from 27 cents to 25 cents per share.
Got it.
So
I don't know why I thought it was getting 31 cents per share, but
it used to. It used to.
Got it.
And they cut the dividend a year and a half ago or something like that.
Got it. So now it's just 3 divided by 12, so 25
which is
cents.
fine.
Yeah, it's fine. Okay. You got me scared, my guy. I thought I was like getting a 20% income hit there or something.
But this is I mean, look, I'm in the city all the time. New York is
It's buzzing.
It's buzzing. It's buzzing.
Yeah. I mean, my sister told me even like she went last year in December, January timeframe, and she was just like, there was people everywhere. She was like, it was crazy. She was like, I could barely move.
I'll tell you, I'm still a fan of Altria Group. I know a lot of people don't like it. I think it's gonna come back next year. We'll see.
I'm very conflicted because I used to have a lot of shares, and it just was hanging out. And at one point, it was one of my better performing stocks, because it mooned. I started buying it in like 2012 when I first started investing because I was like, what other stocks to own than the best company in the world, right? One of the best returning stocks of all time. So I started buying it in the mid 30s, low 40s, and it mooned all the way to $75, and I thought I was a genius. And then it's just been on a steady decline, and then it like once it got back down to 40 after the pandemic, it's just been flatlined, and I'm just like, it doesn't make sense to me because they buy back a lot of stock. They've bought into AB InBev, which is a passive dividend for them. So like you have all these income streams, and it's like I understand the regulatory hurdles and the government, liabilities and stuff of the like, but I just it turns off so much cash. And I understand that like they bought some of these, the Jewel and the Kronos acquisition and all that, and they've basically written them off down to basically zero.
I don't hate the Kronos acquisition.
Either do I, but like I just don't understand like at what point do people just realize that the valuation of this is too cheap to pass up?
I'm sorry, you're paying 8.5 times earnings for a cash cow. Take the fact that it's a tobacco company out of it. You look at it from just a company basis, it is a 9.5% dividend that is growing at a mid-single digit rate year over year through 2028 per their projections. Company trades for a very low valuation, and if marijuana becomes legal federally,
that was always the plan. That was always the plan for me.
Really think about that. Who is better suited to take over the industry other than Altria?
That was always my plan, was that one. Although now that I'm looking at it, this could be one of those. I'm looking at the 2026 leaps here, and it doesn't look that bad.
Just keep paying me the dividends. Let me freaking accumulate more shares, and I'll hang out in it. Okay. I like getting paid to be a shareholder. What can I say?
Yeah, I might have to have a conversation with Chris about. I don't know if I'd buy the 40 long call, but I might buy the 42.5 in case it does moon, and it could have some pretty good upside. Let me see. What did I mess up?
Azure Blue, that was a while ago. It recently decreased the dividend from 27.08 cents to 25 cents because of the 625 Madison sale and because of debt, I believe. but it was just announced like 2 weeks ago. The dividend went from $3.25 a share to $3 a share. Regardless, I'm up a ton on it, so I could care less.
I might have to do this one because it's like right now, if you look at and I could probably get a better cost basis because Robinhood spreads on their options.
You really like these spreads, huh?
I don't. I'm not normally a guy, but like to me, this is a trade for me. I don't know if I would buy back into Ultra Group for the long term, but I could see throwing $5,000 on a Hail Mary play and try to turn it into 50. Like, I don't know. You could buy them. Basically, what it's saying is you could buy these bad boys for, oh wow, the bid could be really low. So if you get it at $1.38, and you're able to get, you could probably get the 45 to 55 debit spread for 2026 for like $1.10, $1.20.
I don't even know if I want to do that.
You don't think it would go?
I just don't know that's worth it. I mean, look at this. So I got a 5-year chart open. Let me make it bigger. Hold on. Since summer 2022, it has just traded between 40 and 50. And every time it's gone toward 40, it's bounced off. It wants to have a floor around $40.
Yeah.
It
Agreed.
dipped below 40 for like 2 days in October during the crash. It wants to have a bottom around 40. I mean, during COVID, it went below 40 a couple of times, but very briefly. I mean, I think around 40 is a legit floor for Altria. I don't think that this area is a bad idea for me. And 9.5% yield with a mid-single digit annualized dividend growth. I mean, I don't really care if Altria doesn't go up as long as it stays sideways, to be honest with you. The powers of compounding will increase my dividend yield on cost. They'll just keep going up.
You're not wrong. I mean, the thing is, though, is it's like you're going to have to pay for the dividends of 15, 20%. That's fine. You're going to get a 6-7% yield from that.
What do you mean? The yield's 9.5%.
9.5. Okay, so 8.5% yield after you take into factor the taxes, unless you put it in a Roth or something.
I don't care about taxes. Come on now.
I know, and taxes are inevitable. I'm just thinking, in terms of
taxes mean you made money. Nobody.
Yeah, I'm not saying you're wrong. I'm just talking about the total return, even if it stays flat, which I anticipate.
No,
get back to
that's
growth.
not necessarily true, because if I end up owing money on taxes, I'm not selling anything from my portfolio. I'm paying it from a cash account. So that investment's never changing. That's just money that's going to go to offset it from somewhere else. It's completely different. It's not like I'm selling shares to pay the taxes.
Yeah.
So this will keep compounding and the cash coming in. Think about this. You buy every 100 shares you buy, okay? You're generating $392 in dividend. The quarterly dividend is 98 cents. So every 100 shares, you're getting like 2.2 shares. And you're generating another 788 or so in dividend income. Think about how much that's going to compound over a couple of years, including the dividend increases. So depending on what type of position you build, this could be very interesting. I don't know. From an income perspective, this is something that I look at.
Interesting. All right. Well, much appreciated as always. We have a good conversation when you're on. I think that you do a great job with your articles. So be sure everybody
Appreciate it. Thank you.
Follow our boy here on the Twitter verse. Let me post his link for Twitter, and then also be sure that you guys check out the article. Let me post that as well. Here you go.
Appreciate it. Thank you very
for
much.
both of those. And everyone always loves seeing you, whether it's on FinTech Weekly or on Cashflow Chronicles. Everybody gets excited when you're here because you do a phenomenal job. So be sure, if I don't reach out to you, reach out to me. But as always, you're a guest here, and if not a regular for me here on Cashflow Chronicles. Apologies for my crap internet. I'm gonna try to figure this out. I'm gonna call Comcast and rip them a new one because they're like, there's nothing wrong with your equipment. And I'm like, well, then why do I have to restart it 2 times a day?
Just get Starlink.
I can't afford it. I'm broke.
Just get Starlink.
I don't make that Verizon and SLG and Altria Group dividends like you. Yeah. One day. All right, my friend. Thank you so much for filling in for Hot Chris, and I'm much appreciated on the talk through on energy transfer. I'll talk to you soon.
All right. Bye.
Good night, everyone.